We also have now Anand Tandon joining us on the show to talk about the markets, what are his expectations from the budget. So Anand, good afternoon. Thank you so much for joining us on ET Now. And let me actually first go to that big question. What are your expectations coming in from the budget? Are you expecting that the rally that we saw post-election verdict for in the FMCG counters to continue, given the fact that most of them are expecting that the thrust will be on rural India or the consumption themes?
Well, I think the trend towards FMCG or at least consumer consumption-based stocks has already started in the market. And unless there is something dramatic, I think the momentum will likely continue there. That is one of the less performed sectors. And while the valuations may be a little expensive, it hasn't actually done much compared to what the rest of the market sectors have done. Uh, Now, as you said, it is quite likely that you may get an impetus for that in the budget, and one hopes that you will get some tax break, but it is difficult to make guesses, and we might as well just wait and see what happens in a few days.
Anand, I want to talk to you about one basic question. In the last 2 days, the way narrative has changed. Earlier, 90% of them were expecting a September rate cut. Now, 100% are expecting rate cuts, and some of them are expecting rate cuts in July meeting as well, the last meet. And then, of course, the new development on whatever happened with Mr. Trump, his assassination attempt, and the way people are now factoring in, calling it day one on the job. If these two factors come together in September, October, do you think that the rally may, get extended on the higher side, US rally, and hence the impact on India as well, on sentiment?
Well, certainly, I have been in the camp which believes that 2 to 3 months before an election, the Fed will do a rate cut, irrespective of whatever the so-called data indicates. That's been the trend. You may talk about Fed independence, or for that matter, any of central banks being independent, but you don't go into an election with interest rates which are high. And if you have the potential to cut it, you will cut it, irrespective of whatever may the economists may tell you. So, as I see it, a rate cut is inevitable. Whether it happens in July or in September, I don't know. But it will happen before the election in the US. I would imagine 3 months before. So that will roughly put it where we are right now, is when you would expect to see a rate cut. That's politics. It's not economics. Now, will that increase let the rally run? I think, the US market is also looking a little stressed, but otherwise, compared to India, it is actually relatively cheap. And therefore, there is no particular reason why you shouldn't get, to see the rally continue. It may not be across the board. Again, if you take out the top 7 performers in the US, most of the market isn't very expensive or has not done too much. Unlike India, where we've seen a very broad-based rally. So I think the argument for the US to continue doing reasonably well, maybe not at the index level, but at the broader market level, is fairly strong. Coming to India, will that provide an impetus? I think so far the impetus has come purely from the domestic market. And while I think that the foreign players may come in, I think right now there are a lot of other markets also which are running up. So I don't think that there is any great logic for necessarily a swift shift. But the domestic market momentum continues, and unless I think there is either some policy action or the FPO pipeline becomes too large, the IPO pipeline rather becomes too large to kind of take away all the fresh money. Right now there are no signs of nervousness as far as the retailers are concerned.
So, what should the right strategy be for investor traders for this year if the portfolio is up 30-40%? For last 3 years, the portfolios have doubled, and now the call for stretch valuation is becoming louder. Is it prudent to take 20-30% kind of a position off and wait for a correction, however long it might take? Or the right way is to just ride through a correction, because the liquidity will ensure that whatever correction does happen, it may be shallow, 10-20% at max. Or are we opening for 40-50% kind of correction as well? Is the bubble so stretched?
There are several layers of the questions that you put in there. What should you do as a strategy? I think you should stay invested. Hopefully, you've bought reasonably good quality stock, and you can just put a stop loss there and make sure that you don't get wiped out when the turnaround happens. If you bought illiquid stock, then there is a problem. Obviously, you want to be able to move either to more liquid ones, or to make sure that the stop losses are such that you will be able to move out fast. But assuming that you are in reasonably liquid stocks and you can trade in and out, there is no particular reason to be looking away, because the last part of a momentum rally is always the one that gives you the maximum money, and you don't want to be watching stocks moving up. You've already seen, for example, take defense stocks. In the last 3 months, many of them have gone up 40-50%. So, if you said defense was expensive, which it was, it has become even more expensive. So, from a trader's perspective, getting out before the market tells you to get out is not a great idea. As I said, you have to just watch for illiquidity. Now it comes to whether or not we are, whether there will be a shallow correction or a correction. Frankly, if there is a shallow correction, it is no correction at all, because at the end of the day, we've seen, sector rotation happening where few sectors have given up and some of the other sectors have gone up. And, that is not reflected in the index because it is rotated. But you have actually seen many of the gives going away and, some of the stocks retreating 20-30% easily from the peak. So I don't think that a shallow correction is a correction at all. If at all, if and when there is a correction, it should be fairly deep. But, it's not possible to time it. So, you can't stay away from the market based on that. As a longer term investor, I would argue just stay with the asset allocation, make sure that you are reasonable quality. And unless and until there is a deep enough correction which merits moving out, there is no particular reason why you should be doing anything with the market other than staying there.
Anand, have you trimmed any of your positions? I don't want to talk about the specific position, but just to understand categories. Or when was the last time you actually added a new idea in your portfolio?
But, you do a little bit of tactical investing, but from a strategic perspective, not anything recent.
Flavor of your tactical activity?
So there is some, corporate developments that you keep looking at, and therefore, wherever there are announcements, for example, of capital restructuring or company splitting and so on, those are usually opportunities where if a company splits up and sets up multiple other companies which are listed, you will find that there are the overall market value actually goes up. So some of those companies are portfolios, are investments which one could make.
Able to spot a lot of special situations in this market, right?
Yeah, there are quite a few which I think you are able to get opportunities in.
Right. Raymond is one such company which has done a lot of corporate restructuring and has guided the market about value creation intentions via those. And the stock, look at that, another 5% at 2300. Kunal, where is it going from here on?
Yeah, I think this has been a phenomenal. Even after the special situation for the stock, it's moved up another 350 points if I'm not wrong.
Yeah.
1900 or 2000 was the low the stock had made on that day, and now it's at 2300. So I think it's an exceptional move. I mean, very difficult to now categorize that. Where could these stocks get into some sort of corrective phases, or whether downtrend starts off for these names. I think what this move over the last 1-2 months has shown is that we can just place the supports on the higher side and keep on riding the trend. That's the best way to try and ride.
Well, very interesting moves coming in on Raymond actually. The fact that no doubt 1 month, 1 week could just be a blip actually in the rise of Raymond. But let's put the spotlight on some consumption name. Then Asian Paints will be reporting its numbers actually in this week alone, or maybe tomorrow actually when we are off. Let's bring on board Vinny to understand how were the numbers, or what are the street expecting about the numbers for Asian Paints, Vinny?
Yes, so Asian Paints is set to report its numbers. We're expecting a muted revenue growth this time, largely just a decline of 0.1%. 9,173 crores is what the revenue is expected at. Even the profitability and the margins are expected to be under pressure. So overall, what we're seeing in terms of the profits of the company, expected to see a decline of 12%. On the EBITDA and operational front, a decline of 8% is what we're expecting, while margins expected to see a contraction of around 200 basis points, you could say, 21.3% this time expected versus last time 23.1%. Volume growth, what we're expecting, domestic volume growth of around 7% this time. Keep an eye out especially on the decorative business, how that volume growth is shaping up now. That's going to be a key factor to watch out for. Now let's not forget Q1 this time, obviously we did have the election impact that came in, heat wave, so demand trend was quite a bit of a subduedness or dullness is what we've seen. So keeping an eye out on that. Other than that, sales were also impacted due to price cuts that were taken of around 4% is what we could say, and the adverse mix is something that's impacting the company's sales overall as well. margins, higher ad spends, negative operating leverage, and a one-off in the base quarter is something that's impacting the EBITDA margins of the company, and that is why a contraction this time. So yes, keep an eye out overall in terms of the commentary that will come in for the demand trends, rural-urban demand trends, how is that shaping up. Other than that, the decorative volume growth and overall the volume growth for the companies, and anything in terms of pricing strategy that we could understand, or in terms of the commodity pricing, inflation, or how is that shaping up, those are key factors to watch out for from Asian Paints.
All right, so that's what you should expect from LTI, I beg your pardon, Asian Paints. In fact, talking about LTIMindtree, the reason why that stock is on my mind is because that one will also be reporting its numbers tomorrow. Anisha is here to exactly tell us what should we expect from LTIMindtree when they report their numbers tomorrow. Anisha?
Well, LTIMindtree is expected to show a bit of a pickup in growth this quarter. So we are working with a constant currency revenue growth of 2% in this quarter, and that means that the dollar revenue could be closer to $1,090 million. The rupee revenue is also expected to be above the mark of 9,000 crore for this quarter gone by. Margins are also expected to see a bit of an expansion. So we're working with a number of 15.2%, and that compares with 14.7% that the company reported in the quarter gone by. So an uptick of 50 basis points, and all of this will also trickle down to profitability. There we are seeing a faster growth of around 4.5%, so that the profit comes in closer to 1150 crores. We are expecting that there is going to be an uptick in the overall top client spend of LTIMindtree. BFSI vertical has shown signs of a turnaround, so that should augur well. The manufacturing vertical had come very strong for TCS. Is that the case for LTIMindtree is also something to watch out for. Margin tailwinds are lacking because the margin tailwinds are coming in, to be honest, from the fact that the project cancellations which were there will not happen this time around, plus the growth leverage will come in. So the tailwinds are there, and we are also watching out for the visa costs and the large deal transition costs, because that is something that might offset some of those tailwinds. Lastly, in terms of the deal TCV, we are expecting it to be in the range of $1.5 to $1.7 billion, but overall there is an expectation of improved outlook for LTIMindtree as well, because the management commentary was a bit more conservative. While they had called that there are segments which are looking good, maybe this time around the commentary will be a bit more optimistic, is what the street is hoping for.
All right, thank you so much for that, Anisha. Definitely watch out for LTIMindtree when they actually report their numbers tomorrow, that is. But Naresh, let me come to you. And one sector actually we've not spoken about of late, and has to be gold linked stocks, jewelers, as well as the one who are into gold financing. How are these counters looking to you? Titan has had a rough patch actually with their Q1 update also not being that supportive. What's your take on these companies? Do you think they warrant a fresh look, or you think it's a time to take it a bit easy?
So, given the rally we've seen in the jewelry names, something like Kalyan Jewellers has gone up from 100 to 500 over the last 1 year. We've seen majority of these names do well, even whether it's a new company, new IPO companies like Sky Gold, etc. So the play right now is to look at gold financing companies, because these companies have gone through a tough patch. So if you look at Manappuram Finance, the stock was at 220 back in 2021, and since then the stock went all the way to 90 and has now come back. Pre-COVID also the stock used to be 190, 200 odd levels. So the stock has done nothing over the last 4 or 5 years now. So this looks promising. Same is the case with the Muthoot Finance, which has also started making a structural move into a new all-time high. So going forward on dips as well as current levels, I would prefer gold finance over gold jewelry companies.
Gold finance or gold jewelry companies. What's your take, Anand? Are you also of similar views when it comes to, if you are looking at that particular space, it would be much better advisable to look at gold financiers than the companies that actually deal in the jewelry business?
I would prefer gold itself. It is easier, it is simpler, and it is not complicated by what management does. So if you are bullish on gold, and that is the reason you are looking at it as a diversification, there is no reason to look at anything else other than buying the gold itself. Jewelry companies will, especially Titan, because you had a strong rally in the underlying commodity price, there is some bit of less offtake that happens because people are resistant to higher gold prices. Until that becomes psychologically accepted, there will be some slowdown in terms of demand. But given the way that the demand in India is driven in terms of marriages and as a saving habit, I don't think that's going to change anytime soon. So the best thing is that if you are looking at wanting to play it through a derivative like a corporate, it's best to stay with a company which has a proven track record with a good corporate governance and where there is no question of of not being able to deliver over a period of time. So I think I wouldn't move down too far. As I said, best way of playing gold is to buy gold.
Right, best way to play that particular space, according to Anand, is to buy gold.
If you like this video, then like, share and subscribe to ET Now.